What's happening in the world of finance? The Intuition Finance Digest gives you a unique take on the industry's biggest trends. A breakthrough AI model by Chinese upstart DeepSeek created a storm in global financial markets in January, slashing nearly 1 trillion US dollars of US tech sector market capitalization in a single day and forcing a dramatic rethink of AI valuations. Nvidia plunged 17%, with other semiconductor stocks also suffering steep single day losses, including Broadcom, which went down 17%, Marvell Technology 19%, and Micron 11%. The Philadelphia Semiconductor Index dropped 9.2%, its sharpest decline since March 2020. In absolute terms, the losses were even more striking. Nvidia's 17% decline wiped out nearly 600 billion US dollars in market capitalization, accounting for about half of the overall losses. This reflects Nvidia's newfound status as the world's most valuable company and underscores growing concerns over concentration risk. The US stock market is experiencing unprecedented concentration, with just 26 stocks now accounting for half of the S&P 500's value. The overall market's strong dependence on a few tech giants like Nvidia raises concerns about diversification. Also, the rich valuations of these stocks may imply lower long term returns while making them, and therefore the market, especially vulnerable to changes in the narrative that prop them up. The concentration effect was seen across the so called Magnificent Seven tech giants. While Microsoft's and Meta's 3.9% and 3.1% declines may seem modest in percentage terms, they translated to billions in lost market capitalization. The DeepSeek debacle was good for hedge funds on aggregate, particularly those that had built short positions. Nvidia related stocks and exchange traded funds or ETFs and utilities and energy companies also suffered, but according to Goldman Sachs, hedge funds had on aggregate meaningfully reduced net exposure to the affected areas. With all of this upheaval in markets, the real question is, why does DeepSeek matter? The scale of the DeepSeek impact comes down to the sheer magnitude of capital expenditure deployed and projected in AI development and investor perceptions regarding this capital expenditure. The largest tech firms have spent heavily on AI development, including cloud infrastructure, specialized chips, and large scale AI models. Nvidia alone saw its data center revenue more than triple year over year, reflecting soaring demand for AI accelerators. Microsoft, Google, and Meta have each directed tens of billions into AI related capital expenditure, with Microsoft's AI investments reaching an estimated 50 billion US dollars in 2023 and projecting a further 100 billion US dollars or so of spending. More recently, President Donald Trump announced the Stargate project, a private sector initiative involving OpenAI, MGX, Oracle, and SoftBank, aiming to invest up to 500 billion US dollars in AI infrastructure. This ambitious plan underscores the escalating commitment to AI development at the highest levels. The rationale put forward by the companies themselves for the heavy spending was to widen the competitive gap the giants have over potential disruptors. Unlike past technological cycles where new entrants could disrupt incumbents, AI development would favour those with the capital to invest at scale and the balance sheets to support it. In short, barriers to entry were perceived to be high, and the tech giants were investing in AI moats, a word that we'll probably be hearing a lot of in forthcoming discussion of this event and its implications. As we've seen from the stock market recently, investors bought the narrative, and it was reflected in significant stock market gains for those giants investing heavily in capital expenditure and the resulting heavy concentration. When a previously unknown company came along with a model that has similar capabilities to those of the giants at a cost of reportedly just 5 to 6 million US dollars, it posed a major challenge to this consensus. This was exactly what was not supposed to happen, and the market reaction was all the more pronounced given how heavily positioned investors were in this view through those tech giants. While details are yet to emerge about DeepSeek's capabilities, and there's also a lot of talk about the stated development cost of 5 to 6 million and how it may be understated, DeepSeek's AI model has nonetheless demonstrated that high performance AI can be achieved with significantly lower investment. It's likely to have meaningful implications across a wide range of areas, including AI infrastructure and hardware investment, software investment and supply chains, especially for semiconductors, the energy and utility sector valuations, global trade, and geopolitics. Let's take a look at some of these. It was previously assumed that AI development, notably the training and operation of AI systems, required heavy investment in infrastructure such as data centers. Tech giants have set aside vast amounts of capital, more than half of which is to be allocated to projects within the US. Meta, the parent company of Facebook and Instagram, has projected up to 65 billion US dollars of capital expenditure this year, including funding for a large scale data center project in Louisiana. Microsoft projects investment of approximately 80 billion US dollars in 2025 in similar centers. These plans will likely need to be reassessed. According to Goldman Sachs, companies will now look for more affordable infrastructure solutions, taking advantage of lower barriers to entry into a much more competitive AI market. The focus could now shift to flexible infrastructure solutions that enable quick scaling, integration of lower carbon technologies, including carbon capture and renewable energy sources, and virtual power plants or VPPs as alternative solutions for data center needs. The DeepSeek model was built using 10,000 NVIDIA General Processing Units or GPUs. They showed they could develop competitive AI models using only 2,000 specialized chips, while other leading models require 16,000. It's no wonder then that NVIDIA and other semiconductor companies suffered such large stock market losses. If powerful AI systems can be built with fewer chips than previously believed, it lowers semiconductor demand and forces changes to supply chains. DeepSeek's cost efficient model has significant potential knock on effects on other sectors, notably utilities and energy, in particular, producers of natural gas, a key feedstock for power generation. Utilities were among the top performing sectors in the S&P 500 in 2024, largely on expectations of strong electricity demand from energy intensive data centers. Data centers in the United States used 4.4% of total electricity in 2023. Lower AI development costs could push even faster automation in cognitive jobs and change what companies will need from workers. New opportunities are likely in AI system optimization and maintenance, workforce development programs, and research and development initiatives. DeepSeek, and particularly the decision to open source its AI models, has significant implications for global trade dynamics. By sharing its code with businesses and researchers across the globe, DeepSeek has lowered barriers to entry, enabling a broader range of entities to develop and implement AI solutions. This move has intensified competition across various sectors globally, as organizations can now access and build upon state of the art AI models without incurring substantial development costs. DeepSeek's breakthrough no doubt raises alarm bells for those in the West concerned about China's abilities. DeepSeek, in this regard, is a major challenge to the US strategy to contain China's AI progress through export limits. Reactions in the investment community, from institutional investors to sell side analysts to hedge funds, were mixed, as are the recommendations on what investors should or should not do. Some investors and analysts are calling this a Sputnik moment for the AI industry. Brian Jacobson, chief economist at Annex Wealth Management, said DeepSeek could be the proverbial better mousetrap that could disrupt the entire AI narrative. Others see the event as a welcome correction in overinflated AI valuations and recalibration of risk, but don't see it derailing the AI growth story. Main Street Research, with 2.5 billion US dollars in assets under management, believes that market volatility continues, but DeepSeek poses no real threat to established companies. UBS analysts note the tendency for tech indices to bounce back consistently over 12 months after a 10% reset. On Nvidia, opinion is also divided. Charu Chinana, chief investment strategist at Saxo, sees fiercer competition in AI challenging Nvidia's market position. Meanwhile, Daniel Morgan, senior portfolio manager at Synovis Trust Company, which owns nearly 1 million shares, calls the recent market reaction excessive and presumably does not plan to sell. There are also those who believe Nvidia may ultimately benefit. While DeepSeek may hurt Nvidia in the short term, It blows the market open to competition, and the other disruptors that can now enter the market will all require chips. As of the start of February, Nvidia Corporation is trading around 120 US dollars per share with plenty of volatility. Analyst consensus price targets are around 175 US dollars, suggesting potential upside of around 40% from current prices. These reflect undeniably punchy assumptions on Nvidia's future performance that will need to be revisited. From a contrarian, this universal bullishness does not bode well for the stock, and price targets will need to be downgraded. Some believe the tech sector needs a major reset. Analysis from Bank of America shows that 19 out of 20 tech valuation metrics are at extremes. The S&P 500's trailing price to earnings ratio of 25.3 times is 70% above its 125-year average. All of this points to a possible market correction ahead.